Okay, folks, we'll get started. Let's see, set up all right? Good. Hey.
I cannot hear you. I'm not sure if you can hear me, but I can't hear you. You're on mute.
How's that? Better?
Yeah, I can hear you now. Can you hear me?
Okay. Can hear you now, yeah. There's a bit of an echo. But we'll work through it.
Ranvir, I'm not sure if you just asked me to start, but I did lose you on audio, so I'm not sure what you just said, if you said anything.
Lost me on audio because there's an echo with my mic. But
Ah.
I was saying thank you for doing this for us. We really appreciate you, and take it away.
Very good. Okay, well, here we go. So yeah, I'm not sure if Ranvir gave an introduction for me, but just for those of you who don't know me, I know a lot of you in the room have met me before, but for those who don't, my name's Unaiz Bawa. I am yeah, located locally here in Edmonton, but unfortunately I couldn't join in person today. But for next time, I hope to see you in person, and I hope to meet you to work on various cases in the coming year. But yeah, my name is Unaiz Bawa. I'm the local tax guy. So that means if you're working on any kind of larger complex estate planning or even living benefits cases, you can certainly bring me in for support. By trade, I'm a chartered accountant, and I've been in this role for a little over 5 years now, servicing various parts of the Midwest. I currently service all of Alberta, all of Saskatchewan. But again, I'm local to here in Edmonton, and yeah, by background, I'm a chartered accountant, and I've historically worked with owner-managed businesses in the realm of tax planning, so that's succession and estate planning, and that piece, which of course is very germane to what you do as financial advisors. So today we'll be talking about business owners and how life insurance can be helpful for them. Um, Now, as I'm not there in person with you physically, if there are any questions, I will pause a few times throughout the session just to check in. But if not, I expect Ranvir will just jump in to let me know we have a question, and we'll be happy to take that. I understand it's not a huge crowd there, so please do just jump in with any questions you have at any point throughout the session. So just a quick disclaimer, this is for educational purposes only, and every client should attain their own professional accounting or legal advice. So when we're talking about estate planning for business owners, there are broadly kind of two approaches, and one would be addressing the needs. And again, we're going to dig into both of these approaches, but one would be addressing the needs, and one would be looking at the opportunities. So, and one is typically a little bit short term, and one might be a little bit more long term. So when we're looking at the approach, I mean, at the very core of it, an advisor might choose to just make an introduction to a potential client or leave their business card per se. But really, we should be digging into the needs of the client or the facts of the client to see are they in need of some estate planning, or is there an opportunity for estate planning? And looking at one or the other is not necessarily a bad thing, but in truth, typically we should have both. Usually something starts out as a need, and in the mid to longer term, that converts to an opportunity. So really, again, we should focus on needs first and then focus on opportunities. You know, save a few specific scenarios, almost everyone will have some type of need. Again, I say almost everyone, certainly not everyone. And then how many of those clients that have the needs turn into those with opportunities will be fewer, but there will be some of those as well. But rarely will you see someone that has an opportunity that did not have a need. Maybe that need's been fulfilled, maybe it hasn't, but typically if they're in that opportunity stage, they were in the need stage first. So what are the needs? So these are the things that I think a lot of you folks are going to be familiar with, a lot of you work with and talk about lots. And a lot of these are fairly straightforward. And a lot of them, even though sometimes the solution to it is relatively simple, like a term policy, sometimes the need can be a little bit complex. So I'm thinking of, your crisscross buy-sell arrangements and share redemption buy-sell arrangements and that type of thing. It technically falls into a need, but it is a little bit heavier on the technical side. So what are the more typical needs? Income replacement, looking after family upon death, final expenses, including settlement of tax debt and probate fees and that type of thing. Debt protection, again, that's, for the event of a death of the breadwinner of a family and looking after the surviving family members. You could have potential charitable thoughts, but that usually leans more into the opportunity side. But typically we do see that people, if they're charitably minded, they're thinking of that even from the early stages. So your needs are going to be things that we're all pretty familiar with. When we're talking towards the needs, though, we don't necessarily just want to say that, hey, here are some needs, you probably have one of them, let's make it fit. No, we should tailor that needs discussion specifically to the client. And of course, we start with the facts around the needs discussion for the client, and then again, that can evolve into the opportunity piece. And really that just speaks to good financial advising being about planning and the people, not about the product, right? So we want to give good planning, good advice. So fact finding, now this is a process that is useful for yourself, but to help them put the right plan in place, but also for the clients, because again, the clients are often unaware of the potential issues that you're going to uncover or help them uncover during the fact finding process, right? So there are a lot of good examples of this, where a client hasn't thought about a buy sell scenario. They may be aware of some tax on death, but they're not fully aware of how much that is, or that the spousal rollover can work, but if you do a spousal rollover, or do we have an estate equalization concern perhaps, right? So fact finding is generally a very good consideration for the client as well. Now, fact finding for something like estate or succession planning doesn't just end there, but a lot of times you start the discussion with the client, and that actually results in the need or desire to do a full-on corporate reorganization, because hey, depending on what we're trying to achieve in the next however many 15, 20, 30 years, actually a different corporate organization would make more sense. And this is where, something that I became familiar with as an accountant, and something that I see now as well, is that usually a client wants to have an opportunity to speak about their story, whether it's a personal life story of how they came to be in the personal position they're in, if they're even a T4 employee, something somewhere, or especially if they're a business owner, to tell the story of how the business grew, what's important now, what kind of growth they want to do, how they envision their exit plan, all of those kinds of things, right? And again, something like an exit plan, even though it's something that we as advisors and planners often talk about, a lot of times the client hasn't even thought about that because they're just focused on growth and they're going full steam ahead, right? So the fact finding process is something that we spend a lot of time with clients on the large and complex cases, because once we know exactly where they've been and where they want to go, then making recommendations isn't always the most complex thing. Good fact finding gives all of that to us. And fact finding, right now we're speaking more on the needs piece, but the fact finding process for the needs type of scenario is not all that different for the opportunity scenario. It's actually the same, and one leads into the other. As far as fact finders go, and we'll give you some resources at the end of the session about where to get the fact finders, but using a long form fact finder is very good. And a long form fact finder is going to again talk about the family situation, talk about net worth and income and cash flow from a personal and corporate or business perspective, and it'll talk about what the plan is going forward. So with corporate business owners, a big piece is, what is the exit plan? Are you doing a sale to a third party or to a family member? Is it a share sale or is it an asset sale? Now, again, a lot of these things are going to be considerations that the client has what it is. So sometimes you have to have that discussion and explain to them, well, here's why you do one, here's how you do the other. Why would you do one over the other? How do you do one over the other? What are the benefits and drawbacks? And what does it mean for you? So having all of that discussion is very important. A short form fact finder that just asks what is your corporate structure and what is the value, like that's good, but again, sometimes we need to know the full story. Things like a blended family, all of that can really suggest a lot to us. Speaking of corporate structure, and I've got a few a sample corporate structure that we'll be looking at anyway, but when we talk about corporate structure, it's not just about percentage of ownership. There are different classes of shares. There can be different rights to shares. Are they voting or non-voting? Are they participating or not participating? Are they preferred shares at a fixed redemption value or not? Are they growth shares? So all of that actually is very important to know. And also another thing that we often see is people refer to a client having a hold co. Well, a hold co is kind of a nondescript term. A holdco can be a parent to an opco. It can be a sister to an opco. It can be kind of neither. It can be a corporate beneficiary of a family trust that's involved. So there are a lot of different ways to think about where a holdco fits in. So understanding the exact situation is very important. So digging in deeper to each of the components of fact finding, let's talk about families, right? So what's the client's own scenario in terms of family? You know, like do they have a family? Do they not have a family? Which spouse are they on, right? First, second, third. Are they kids? Are there kids? Which marriage did they come from? Are the kids married themselves? Are there grandkids? And a lot of times a client's experience in all of that will speak to how they view matrimonial protection. And again, when we look at the needs side of estate planning, matrimonial protection can come in. Now, you're not going to necessarily make a recommendation for certain estate planning just based on matrimonial protection, but how we execute it might be guided by what kind of matrimonial protection they're looking at. Citizenship is a big item. So we most often run into U.S. citizenship. So why do we care about citizenship with the U.S.? Well, the U.S. is one of only two in the whole world. The U.S. is one of only two jurisdictions that taxes on citizenship. So you can have nothing to do with the U.S., but if you are a citizen by birth or from some other tie, then depending on your income, you may have to file taxes there. Even if you have an inheritance, you might be tied up with some U.S. tax. So understanding U.S. citizenship is very important. For those of you that care, the other jurisdiction in the world that taxes based on citizenship is an African nation called Eritrea. But other than those two countries, no one else taxes on citizenship. They tax on residency. So residency is another big thing to understand. We typically assume Canadian residency. There are situations of dual residencies, but then we get into tiebreaker scenarios. So the short of it is understanding citizenship and residency is very important. Not to mention, like I'm talking about from a tax and a planning perspective, but as far as like that whole issuance of insurance policies, I mean, you have to be on Canadian soil for that, and there are all of the considerations there as well. But just from a tax perspective, you got to understand citizenship and residency. And then, of course, there's relationships and family dynamics. Now, how do the parents feel about, you know, the one kid that's always been involved in the business versus how do they feel about, you know, the other kid that they haven't spoken to in 2 decades or something, right? So understanding that and putting that into the planning is very important. And that actually does speak to a very important part around estate equalization. Where you know, maybe one kid's taken over a business, they're getting a deal on the business because they're taking it over from mom and dad, and then there are the other two kids that have nothing to do with the business, but mom and dad want to give them something, but all of their money was always tied up in the business. So how can we make sure that all the kids get something from mom and dad, right? If we look at the personal net worth side of the fact finding, what do they own? How do they own it? Do they own stuff through a corporation? Do they own it personally? Do they own it in other jurisdictions? For personal assets, registered and non-registered assets each have different tax exposure. Real estate investments often have an accrued gain. Real estate investments are sometimes not perfectly liquid, right? So we can't sell them at their value turnkey. So how do we deal with that? And perhaps mom and dad don't wish to sell the real estate investments. They maybe want to keep it as, like a proverbial cash cow, a rental property that'll be intergenerational. Well, you still may have tax to pay on that. Maybe there's a family recreational property like a cottage. How are we going to deal with that, right? Understanding the tax attributes of everything. So typically we're going to be concerned with fair value and ACB, adjusted cost base. There is another tax attribute which we can be concerned with sometimes called PUC, paid up capital. I won't really get into it today, but it is another thing similar to ACB. Is there existing insurance policy in place anywhere with mom and dad? That is an asset, of course. Term policies are just worth something for when someone passes away, but there could be living benefits policies with the return of premium on them. We want to be aware of that. And lastly, where are mom and dad drawing their income from, salary or dividends from their corps? Do they have other investments? Was there intergenerational money left to them from trusts? All of that is something to look at. Then, of course, getting into the org chart and the structure of the business. So again, like I said before, there isn't really, I guess, an org chart is never as simple as we want it to be. Typically, actually, I shouldn't say that. Not always. In a case of someone like a doctor with a prof corp, maybe it could be very simple. But even in those scenarios, it often isn't. We usually need to go back to the accountant, or if I'm working with an advisor for the first time, I have to go back to the advisor and say, hey, we need to understand a greater detail of the share structure you've given. You said mom and dad own it 50-50. Is it the same class of shares? Is it a different class of shares? If there is a family trust involved, who are the trustees and beneficiaries of the trust? All of that part is very important. Understanding if there is a shareholders agreement in place already or not. If there isn't, well, that's fine, but then we're going to have to consider if we have the intent for a buy sell, is the current USA going to give us the right direction on the buy sell if one business partner passes away or not? Are there debts to the business? If there are debts, do any of them have covenants? So like a lender or a bank will say, well, we'll give you this debt, but you need to secure it with XYZ asset. If XYZ asset is very important to the business, we might want to cover that debt with some kind of estate planning. And sometimes debts will straight up have to be covered by insurance policies as well. And in that case, you may end up having a bit of a deduction on the premium, but typically premiums are non-deductible for tax purposes. When we're thinking about the overall corporate structure and planning, and if we need to do a reorganization, how's the client use their lifetime capital gains exemption? Do they plan to use their lifetime capital gains exemption? Do they plan to do a third-party sale, or do they plan to pass it on to the kids? Or are they just going to wind it up and turn it into a holdco? So like in Alberta, if there's a doctor with a prof corp, basically it's an opco until they're practicing, and then when they stop practicing, it kind of turns into a holdco. Like it's not like we even move the assets. The corp that previously was a prof corp just turns into a holdco. So that is a more simple scenario, right? So understanding all of that. And then, of course, we got to think about the values. What is the corporation worth? What's it going to be worth in the future? What is the projection for that growth? And based on that growth, what kind of investments does it have? What is the tax rate it's going to be subject to? And of course, if there is going to be a transition of the corporation, depending on how and when and to whom it transitions, is there a tax liability there that we're going to be concerned with? And of course, is there any existing coverage in place anywhere? And then one thing that, I mean, is kind of a no-brainer, but a lot of times we end up missing, is what is the client concerned about? So if a client comes to you and says that, hey, I'm concerned with this thing, but then through the fact-finding process, we find a bunch of other stuff. First and foremost, we do need to actually make sure that the client's concern that they came to you with that they want to address, but that is also being addressed, right? Understanding how they're going to retire, when they want to retire, making sure the cash flow for that all fits. And as long as that fits, well, then we can consider the next step, which would be the estate planning, right? So, I mean, first we do our business planning is typically the first step, making sure that we have cash flow for today. Retirement planning is the next part, making sure we have cash flow for tomorrow. And then after that, we get into succession and estate planning, cash flow for the next generation, or passing the business on to the next generation. And after that, we can think about philanthropy, right? If I'm looked after today, if I'm looked after tomorrow, if my kids are looked after the day after tomorrow, then should I give something to a charity beyond that, right? And if we have philanthropic objectives, there are a lot of good ways to consider that, both from a wealth product perspective or an estate planning product perspective. And now a lot of times people aren't going to ask or aren't going to be able to answer the question that you directly ask. So if you tell them, hey, we're doing the fact finding on your business, are you going to do a share sale or a third or an asset sale? Are you going to do a third party sale? Or are you going to sell to your kids? Well, that's too direct of a question, and they probably don't know how to answer that. So we need to guide them to think about the answer, and when they know that answer, then they'll realize, oh, well, now that I've given you the answer and I know that I'm going to do an asset sale because of the nature of the business, and I'm not going to do a share sale. And I know that I likely have to sell to a third party because my kids just aren't going to be interested in taking this over. If they are going to take it over, they're going to need help from a third party. Well, now we know the concerns are, you know, the corporate structure, or the concerns are having a buy sell in place for when the third party comes, or whatever it may be, right? But the client wouldn't be able to tell you that off the bat, so we need to kind of guide them into that by asking them open-ended questions. Tell me about your family, tell me about your business, what is your investment philosophy, what do you want to accomplish with your business, what do you want to accomplish personally, have you thought about retirement, what are you going to do with your business? Have you thought about the fact that your kids may not all agree on what happens with your assets upon your death, right? So having all of those discussions, or having those open-ended questions, lead to the right discussion with the client. If you just want to kind of walk away with what's really important from a fact-finding perspective, we need a detailed corporate organizational chart. Typically, we need a net worth statement outlining all of the assets and liabilities. We should understand what the client's testamentary wishes are. Often enough, the client's testamentary wishes and what's in the wills are not aligned. They're two different items, but usually we'll get a draft of the will, and then they'll say, well, our testamentary wishes are this. We'll see where the gap is, and then we'll tell them update the will this way. And while you're doing that, consider the other planning processes that and products that we're recommending here. Is there a shareholders agreement for the corporation? If there is, and we're talking about a buy sell specifically, or a key person type of scenario, having a USA or shareholders agreement is important. Looking at tax returns or financial statements are both very important. And if there's a trust involved, having the trust deed, or at least a summary of the trust deed, either from the client's accountant or lawyer, is important. So what's an example of how, the client can say something and then the advisor can hear something, but the reality is something else entirely. So if a client says that they have a company and it's worth 5 million, and you want to meet to talk about estate planning using life insurance, you might assume that, okay, if the business is worth 5 million, the tax on that will be 1.25 million upon death. Just quick and dirty numbers. You can round it up to 1.5 to account for a bit of growth and maybe some stuff on the personal side. But okay, maybe that's what they need. 1.5 million in permanent coverage. Great, let's do something. But we should look at the org chart, right? So what if the org chart looks like this? This is not an atypical org chart. Org charts often look like this. Often they're more complicated than this. Often they're simpler than this, but they need to get to this level of complexity for good reason. So we have to get into that discussion with the client. So here we have an opco. The opco used to be owned directly by the client. Then we implemented a freeze, and now a family trust owns the opco. And there's also a holdco that's involved as well. So If we look at this, in red, we have growth shares or common shares. In blue, we have fixed value shares, and the dotted line shows that the holdco is a corporate beneficiary of the family trust. So what does all this mean? So the short of it means that while the business, you could say, has a value of 5 million, the tax exposure to our client immediately isn't quite that high. We know that the client, their shares in the holdco are 1.7 million. So the immediate tax exposure to the client is at least the 1.7 million of a gain. So the tax exposure on that is pretty limited. We'll call it about $400,000, much less than the 1.5 that we were thinking of. We also know, based on the shares off to the side here, the 800,000 of fair value and 800,000 of ACB, that the client has utilized their lifetime capital gains exemption. So that's good. We don't have to worry about, have they used it, will they use it in the future, what else is going on, right? We know that the family trust owns the growth of the operating company, so most likely we can attribute the future growth of the opco to the bennies of the family trust, and most likely that's going to be the next generation, or potentially this holding company, which yes, the holding company is owned by our client directly, but that's where typically this holding company we would consider, should we have it owned by the kids instead, or should there be another holding company also owned by the kids? So all of that to say, in this scenario, it's not nearly as simple as what the client would have suggested to you, but we only find this out if we do the right fact finding. So from this organizational chart, again, we know that we have a smaller anticipated tax liability on death. There may be further tax liabilities due to capital gains to the beneficiaries. And again, we also need to consider the date of the family trust, because there is this rollout of assets at the trust 21-year anniversary, and where does that time out in terms of the client's potential passing, right? The client still has time to formulate a succession plan. Like I said, we can think about a holdco for the kids. The holdco can own assets that won't obstruct the sale of the business, which is kind of good. And then, of course, the holdco may hold some passive investment assets, and that might speak to a bit of opportunistic tax planning, depending on the investment philosophy of the client, depending on the tax situation, and depending on is the client looking to tap into their cash value of a policy if they're going to have one, or do they just need it for when they pass away? So what else do we need to know? Well, we got to consider that, what are the personal needs, basically, so do we have to cover, the family for their cash flow if the business owner that is in there doing the business, if they pass away? Are there other assets? Do we have other citizenship considerations as well? Is there any debt? And most importantly, what is the equalization piece, right? Because if we look at the previous org chart and just think, okay, well, that could have been a farm client where we have a qualified farm property exemption and we have a farm rollover, and we can basically dodge a good chunk of the tax. Well, we still might have to contend with the state equalization, and with agricultural clients, that's the biggest thing we plan around, is the state equalization. So at the following website, you do have a short form fact finder and a long form fact finder. You can get either of these by emailing us as well. So I know a lot of you in the crowd know Ranveer's counterpart on the estate planning side. His name's Anderson Chu, the regional sales manager. He isn't with you today, but I know a lot of you know him, and if you don't know him yet, you'll get to know him shortly, and Ranveer can put you in touch with him, but he can direct you to these documents. It's also at the website shown on the webpage right there, or shown on the slide right there. So let's talk about some opportunities. So your client might feel that there's no need for any coverage or protection, and that's fine, because maybe they have very liquid asset base. Maybe they can essentially self-insure because they have enough wealth otherwise, and that's great. That means that they're out of the woods from a needs perspective, but they may still be able to increase their family's overall net worth, particularly on the estate side, for when the first generation passes away, by doing some opportunistic planning. So this will be, again, around maximizing the estate value to the family. maximizing the potential for estate value without necessarily taking cash away from our business operations, because of course it is possible to leverage a cash value. So where is some tax efficiency for corporate owned policies? And corporate owned is the thing that to me as an accountant speaks the greatest. So there's tax advantage growth. Now that you get with or without corporate ownership. And various other investments have other rates of tax. So there is that to consider, and not to say that there isn't tax with a policy. There is, but it is tax advantaged, we'll say. But the biggest advantage is in the distribution upon death, and that's because of the CDA. The CDA basically lets us use corporate money. So we've paid the layer of corporate tax on that money, but the corporate tax we pay is much less than the personal tax, right? So we take corporate money to pay premiums to get the policy in force, but upon death, the CDA credit that we get basically lets us take the money and pay it out to a shareholder tax-free. And because of that, you kind of get a personal benefit by using corporate dollars, which typically you don't really see too often. Now, that's a very simplified way of looking at it. There's a lot of nuance here. So the CDA credit is not always the entire amount of the death benefit. The ACB takes a chunk out of that, but typically the CDA will be the majority or vast majority of the death benefit payout. And of course, there are some stipulations around how much of a corporation's value can exit through the CDA upon the death of a shareholder. But then, there are exceptions to that rule and exceptions to exceptions. So I won't get into all of that today, but just know that while it is a great, essentially double dip that exists in our system, there are some things that we have to plan around sometimes. So who is the client profile for this kind of opportunistic planning? Well, someone that has to be in good health, or a family member, or enough family members in good health. They have to be interested in maximizing family wealth more so from an estate perspective. If they want to spend all their money in the next 10 years, well, sure, there are some ways where it can fit, but it's not necessarily the best utilization. They may or may not need income. They may or may not need liquidity. If they for sure need liquidity in the short term, this is likely not the best way to consider it. And depending on what their investment philosophy is, right? I mean, sometimes people want only equity investments. Well, this is not an equity type of investment, and that's fine. It's not going to be the right opportunity for every client. Understanding where is the asset value, where are the funds, where's the money tied up, right? So it could be personal, it could be in a personal registered asset, it could be in a corporation, and it could be somewhere else, right? It could be offshore. So understanding where that is will speak to the way we can plan around this. So within the illustration software that we have, and this kind of is something where I'll talk about it a little bit, but really, if you want to dig deeper, I'll say that you should book a call or book some time to chat with my counterpart, Anderson Chu, the wholesaler on this, who can really walk you through how each of these strategies work through our illustration software. But basically, there are various strategies that we talk about, and I'll kind of zoom in on one of them, but we'll just walk through a few of them to begin with. So one would be estate transfer. So just basically saying, hey, you got money on the personal side that you don't need, and you want to give it to your next of kin, but you might want to do something with it. Well, you can invest it and have it go to them. And depending on the investment philosophy, depending on the time frame, that's not a bad idea at all. You can also do that with some kind of permanent coverage. Corporate estate transfer is a similar scenario, but this is where your money's tied up in your corp. Now, again, if you want to invest it personally, you're going to take it out of your corp, pay the dividend rate of tax, and then invest it or gift it to them. Well, with a corporate estate transfer, we're doing a corporately owned policy, and that's where, again, because of the CDA, we kind of get a bit of a double dip, and it's kind of a good planning tool But again, I'll harp on the fact that this really makes good sense when you have money trapped in your corp that you don't need for your retirement, that you don't need for your business. If you need it for retirement, if you need it for business, there are other strategies to talk about. But the greatest strategy, the lowest hanging fruit, the thing that makes the most sense for people in these scenarios is going to be corporate estate transfer. And that's where they have money in their corp, they don't need it personally. It's going to go to the next generation anyway. Let's do it via some kind of permanently owned life insurance. And again, another caveat I'll add to that is that the client should probably have some belief in fixed income investing. If they only believe in, we'll call it wild equity investing, where you can have huge returns, but you can also lose your money, then again, the investment component of this kind of estate product isn't going to make sense to them. And of course, depending on the specific needs analysis, there is universal life and participating life, two different options. If you are trying to maximize business cash flow or optimize for retirement planning, there are these asset efficiency um, or transfer plus strategies where we talk more on the cash value side, how to leverage it, where to leverage it personally, corporately, for business purposes or for personal purposes. Um, and again, this can make a lot of sense, but in the current interest rate environment, it becomes a little bit more challenging. And I mean, I won't speak too much on changing tax rules unless anyone wants to get into it. But with GAR, so the general anti-avoidance rule potentially changing, the more aggressive uh, lending scenarios can maybe become a little bit too aggressive, if you ask me. But again, every client's accountant is going to have their own philosophy on that. And then, of course, as a counterpoint to what I just said on rising interest rates, with rising interest rates, insured annuities can make a little bit more sense. Which I know Ranveer, I think, said he's going to speak on his session a little bit more on that. And again, insured annuity makes sense in a high interest rate environment for those that believe in that type of investments. I know a lot of people who don't believe in fixed income investing. So for them, is an insured annuity going to make sense? Well, not any more than it did before, and before it probably didn't make sense either. So I do want to maybe focus on this corporate estate transfer scenario or strategy, because this, like I said, is kind of the core bread and butter for our large cases. So any of you that are on this call that have worked with me on large cases, and I know there are a few of you that have, I won't mention any names, but those were essentially corporate estate transfer scenarios. I know some of you have done the odd IFA with us, and some of that we use some of the corporate estate transfer tools and apply it one step further. But usually it starts with that discussion around a corporate estate transfer. I'll just pause now really quick to see if there are any questions or comments.
Any questions? No questions.
All right, thanks a lot. I'll just keep going here. So corporate estate transfer, again, this is basically a way to take money that is trapped in your corp and move it to your estate on a tax preferred basis. So the growth is tax advantaged. I won't call it tax free, I'll just call it tax advantaged. But when we move it out of the corp, to whatever extent we have that capital dividend account credit, and again, a large capital dividend account credit is created upon the death benefit payout, to whatever extent we have CDA, we can in fact get a tax-free disbursement to our estate. So when we look at a corporate estate transfer scenario, we're typically going to see a big advantage when it comes to the estate values. So let's look at an example. Here we have Heather, a 50-year-old female non-smoker, standard risk, so young enough and healthy enough to be covered, owns a holding company with investment assets. She's paying investment tax rates on those. And basically, she's going to pass on the value of these assets to your kids. So if we reposition a portion of the corporation's assets to coverage, what might that look like? So again, all of this that we're running, we basically can input the assumptions into the illustration software and run the corporate estate transfer tool, and it'll spit out basically the outlook of the net estate value based on our assumptions. So the assumptions we've given would be a 5% growth rate, and that'll be from a mixture of dividends, interest, and realized capital gains. Again, if you were to run this against all realized capital gains at a higher rate, the numbers aren't going to look as good. And that's why this kind of planning isn't going to be for everyone. This is basically an alternative for fixed income investing, not for every type of investment. But assuming, the assumptions that we just gave, here you can see that we've got net estate values in gray, and the light gray is the net estate value after all has been flowed through. And you can see that compared to the blue, which would be corporate investments, our net estate value is consistently higher. And that's because, again, during our lifetime, the cash value versus the investment value might not look so different. But by the time we flow the money out to the estate, things look a lot better. And that's, again, because of the CDA credit. So if there are any other questions or discussion, I don't have so much more that I was going to go into, but I just kind of want to summarize what we've talked about, that when we're working with clients on these kinds of scenarios and we want to give them the best way to move forward, fact finding is the most important thing. Fact finding is best done with the open-ended questions. And of course, every client's going to have a different level of technical expertise, like sometimes clients, particularly engineers or lawyers, for example, have their own technical bent on things, and maybe you can ask them direct questions, but a vast majority of clients you can't. So that's where you, as the advisor, that's one of the greatest values you bring, is you're that person that can get them to have the hard conversations, ask the hard questions, and so they can understand what are the big issues they have to plan for. And a lot of times, you as the advisor can be the person bringing the client's accountant or lawyer to the fore of this kind of planning, that, hey, why haven't we done this kind of reorg? Why haven't we implemented a family trust? Since I've had the discussion with the client and they are interested in passing the business on to the next generation, or utilizing a third party share sale utilizing a share sale to a third party, why don't we have a family trust in place? All of that is something that you, the financial advisor for the client, can facilitate. And when doing that, that's where you're going to see that there are the needs and the opportunities there for you. And typically needs will come first, opportunities will come second. And it's in that regard that as a company, Canada Life is here to support you. So your first kind of contact or line of defense on the investment side, of course, is Ranveer. On the estate planning side and living benefits side, that's going to be Anderson Chu. He's your regional sales manager for insurance. And then on the life side, you also have a life insurance case specialist, large case specialist, named Terry Brownell, that works with Anderson Chu or Barry Rendell, depending on your MGA. So Anderson can put you in touch with those guys, or loop those guys in for you for the right cases. And then similarly, when we get into the tax planning side and corporate organization side of your advanced cases for estate planning or living benefits, that's where Anderson will typically put you in touch with me, and I'm happy to work with you on cases. So no matter what you're doing, you have the right support here at Canada Life. So Ranveer, I'll pass it back to you for any questions or comments. And if there aren't any, then I'll exit and let you guys get on with the day. But please, if there are questions or comments, I'd love to take them.
Thanks, buddy. Can you, if it's possible, yeah, we'd like to see your pretty face. Thank you. Anybody have any questions that they'd like to ask? Yes, sir, in the back. So, Unaiz, did you hear that?
I did not.
No. Okay, so the question was, he's got a client with a very large income, and he's wondering if corporate. Sorry, he's got a passive income problem, and he's wondering if insurance is a good solution for that.
Yeah, for sure. So it can be, and since we have a little bit of time and you asked such a good question, I'll give you a slightly longer answer than maybe you wanted. So yeah, if you have passive income, you have a little bit of a problem. So if you have too much passive income, then that can chip away at how much of your active business income is taxed at the better rate. So if they have passive income and it's too much, and they also have another stream of active income. So an example of this would be a doctor with a Prof Corp. Their Prof Corp has a couple of million in it that's invested in a portfolio, and their portfolio returns are like 300 grand. Well, they have way too much passive income. And because they have so much passive income, their active business income from their practice as a physician, instead of being taxed at 11%, is now being taxed at 23%. So the accountant has a good way of getting around this, and that is basically, rather than us giving salary to the doctor, or rather than giving a lot of salary, we can just give a small amount of salary. The rest of it we'll give as dividends. So how does that solve the problem? Well, yes, you're still paying the high rate of tax on your active business income, and you're still paying a lot on passive income, like a lot of tax on passive income. But because we're paying the 23% on our active business income, we actually, in the corp, are allowed to give out a type of dividend called an eligible dividend instead of an ineligible dividend. Ineligible dividend is the standard dividend that a shareholder gets that's taxed at a higher rate. But because they're already paying the higher rate on their active business income, they get to give an eligible dividend instead, which is taxed at a lower rate on the personal side. And because they can take the eligible dividend out of their corp, their net tax is going to be the same. So an accountant might say, hey, this is our way of solving the problem. The problem with that is, are we forcing the shareholder to take out more from their corp than they would otherwise need? Are we forcing them to forego RRSP contribution room by forcing them to take dividends instead of salary? So the opportunity there would be, well, let's redirect some of our corporate investment dollars into a corporately owned insurance policy. And through that, we can reduce our passive income, reduce the tax we're paying there, and hopefully get back some of our small business deduction limit. So now our active business income is now going to be not so much at 23%, maybe at 11%. So again, there is another way. An accountant has a way to solve that by giving eligible dividends. But if we can solve it a little bit by doing what we just said with a corporate policy, great, do that, and then let the accountant do their eligible dividend thing as well. The caveat there is, of course, that we should assume that the client doesn't need all of their money for retirement. The best scenario is if some of that money in their corp is going to go to the kids anyway. Even if they need it for retirement, there's a good argument there anyway that you use a corporate policy, let it build up cash value, and then draw it down in retirement. Yes, that is still viable. I know we talk lots about that, but the best use is if it's for the next generation. So great question. I hope I answered it, but I know it was a long answer.
Can you comment on what purification means, and if that would be a potential solution for passive income in a corporation?
Sure. So depending on the nature of the corporation and the business, purification can be a consideration. So purification would basically just mean that the corporation or the corporate structure that we have does not have non-business assets. So why do we care about that? We care about that for mostly two reasons. The one reason is that if you are a shareholder of a corporation and the corporation runs a business and you're going to sell that business, and by selling the business, you want to make use of the lifetime capital gains exemption, you need to make sure that the corporation is pure, so it doesn't have too much in the manner of non-business assets. If you have too much in investments, or if you have, for example, a permanent insurance policy, well, that's a non-business asset, and you don't want that in the corporation that you're going to sell. So typically, we want to have the right structure in place so that your retirement and estate assets are all in a different corporation somewhere. So keeping the entity purified is important from that perspective. The other thing is, of course, that forget about if you're going to use the lifetime capital gains exemption or not. If I, as a shareholder of a corp, I'm going to sell my corp to my neighbor, I don't want my neighbor to have my corporation that has a policy on me and my wife, for example. That doesn't make any sense. So keeping things purified from that estate planning piece is also pretty important. Now, when we talk about purification and the lifetime capital gains exemption, again, this is kind of a little bit more complex in the realm of the estate and succession planning piece. So I know everyone's comfort level is different, but you typically want to be leaning on your experts to help in those conversations.
Thank you. Any other questions? I was wondering, Unaiz, when you're sitting down having these kind of conversations with advisors and with the advisors' clients, are there a few very typical issues that you see often that are like, very common mistakes that business owners make when setting up their businesses, or when it comes to, trying to create tax efficiency?
Yeah, I mean, I would say that the big things are maybe not having the right corporate structure. And I know that that isn't necessarily leaning into a need or an opportunity for, in short, a sale of a wealth or estate planning product. But usually if we can understand where the shortcoming is there and offer that recommendation to the client of how do we fix it, it usually goes hand in hand with the recommendation of something. And when you put your best foot forward and help the client understand that problem, then that's going to result in the business for you, right? So not having the right planning in place ahead of time, doing planning retroactively or reactively isn't as good as doing it proactively. So staying proactive on that is the most important. And then I mean, I guess the other thing would be like not understanding or leaving behind the personal family dynamic piece or the estate equalization piece. A lot of times it sounds kind of silly, but a lot of business owners are kind of just thinking, well, I'll deal with it later, or I'll deal with it, my next of kin can deal with it when I'm dead. But a lot of times, again, if we are being reactive or retroactive, it's not going to work so well. And then there are regrets on the personal side, which it sounds like a silly thing to do because, of course, if we're all in the planning business and we're having those conversations regularly, you'd think that people would be aware of the problems. But I mean, I don't know what the numbers are, but a large amount of Canadians, I think over 50%, don't have a valid will or an updated will. So I mean, that alone tells you how much people are being reactive on this stuff, right? So myself included, I had a kid 6 weeks ago, and I haven't updated my will since that second kid came along. So I mean, I'm one of them. I have a will, and it was up to date, but as of 6 weeks ago, it isn't. So there you go. Case in point.
Dude, that's terrible. What kind of an example are you setting for
I
these
know,
folks?
right? It's horrible.
It's common though, and you're very close. It's 51% of Canadians don't have a will. That's scary. That's just shake your head scary, right? Like, what's going on there? And is it because of lack of advice? Is it because of a lack of resources, or is it just maybe a lack of literacy in terms of understanding what will happen if you don't have a will?
Right. Yeah.
If there aren't any other questions, or sorry,
no, it's all good. I think we were saying the same thing. Go for it.
Awesome. Yeah. So if there's no other questions, Unaiz, thank you so much. That was a wonderful presentation. A big round of applause for Unaiz Bawa. He's such a wealth of knowledge. We're going to take a 5-minute bio break when we get the next presentation set up. So please, there's still coffee and tea and juice and whatnot. If you want anything from the bar, go ahead. It's on me. Or I say that like it's my credit card. But go ahead, spoil yourselves, have fun, and we'll be back in about 5 minutes. Thanks again, Unaiz.